At this year's Tax Policy and the Economy Conference, sponsored by the National Bureau of Economic Research, you presented some new research findings that suggest that the tax treatment of high-income individuals depends a great deal on how pass-through entities, partnerships, and other related entities are taxed under the U.S. tax code. Could you say a little bit about those findings and their implications?
Well, as is well known, the top 1% income share has grown from 1980 to 2013 by 10 percentage points. What's less well known is that more than half of this increase has come in the form of pass-through business income. And so how this income is taxed, which includes carried interest, which includes dividends and capital gains, is an important input into thinking about conversations about inequality and how tax policy interacts with it, and understanding this pass-through income is an important part of that conversation.
One of your findings seems to be that the role of pass-through entities in the U.S. business sector has grown over time. Can you elaborate on the numbers behind that?
Yeah, well, what used to be the case is that 80% of total net business income was earned by traditional C corporations, and the remaining 20% was earned by informal businesses or sole proprietorships. But since then, there's been a dramatic growth in pass-through businesses, which includes both S corporations and partnerships, so that now less than half of total net business income is earned by C corporations, with a rapid growing share, partnerships being the most rapidly growing, but these pass-throughs are increasingly important in business activity in the U.S.
Now, we find pass-through entities of various kinds throughout the income distribution. Some low-income households in informal businesses receive income of this kind, as well as high income. Where has the growth taken place?
Well, much of the growth has come, if you look at where the income is received within the household income distribution, it is incredibly concentrated in the top of the income distribution for formal business pass-through businesses. So S corps and partnerships both see almost 70% of income in 2011 was earned by households in the top 1%.
I see. And how does the tax burden on these different kind of business entities compare? Traditional C corporations, S corporations, partnerships, other pass-through entities?
Yes, so we are able to use tax calculators to estimate the tax rate paid in 2011 for each of these types of businesses. C corporations paid the highest rate at 32%. Partnerships paid the lowest rate at 15.9% among formal businesses, with S corps in between. And the reason why the partnership rate was low is partly due to a large fraction of this income being in preferred tax forms, such as capital gains and dividends, and largely because the partnership form is very flexible, such that foreign entities and tax exempts can also participate, and they face a very low tax burden.
So given that a lot of this income is capital gains related, what industries are these entities operating in?
So they typically classify. So on an income-weighted basis, partnership income is very concentrated in finance and what are called holding companies. So the structures of these underlying businesses are actually somewhat difficult to discern using the tax data that is reported. S corporations have a much more uniform distribution across the industries in the economy, which suggests the rise of pass-through isn't just about finance, but is also affecting a much broader swath of industries.